The point on valuation is important because if I have to choose as a company owner, I wouldn't mind going with an investor who is valuing my company at a lower price, but I know that this person is going to add a lot of value to help me grow. So in some ways, I'm willing to compromise my valuation downwards if the person who comes in has a certain value that he can add that could accelerate the process, versus a passive investor who comes in and gives me a high valuation but is not going to do a lot to help me. So it's a trade-off. You need to decide really where can you get the most value, not today, but over a period of 5 years or 7 years. And this is what is important. And it's the same thing that you do in a relationship. You know, in a relationship, when you start, it's not about, it's how can this person help you grow, and how do you help the other person grow at the same time. And it's not only, maybe the person today is not the best fit. Maybe this fit is a good fit, but not the best fit. But over a period of time, who out of these will be the person that could help you, hi Salemeh, that could help you be able to grow. Salemeh will present afterwards on shareholder agreement. So we have Salemeh Fiandak, please. Okay, so this is quite important. Thank you, Raja. What I'm going to take you now is that we have looked at, I'm going to look at your list, valuation methodology. So you covered, René came up with another one. All around it will give you a certain value, and this value will be either based on the market and other competitors, based on your future flow. If you have already a business in existence, Michel, for instance, works for Technica. Technica has already 20 years behind them. When we do the valuation, we're going to be using discount cash flow because they have a history. Even if a company has 1 year or 2 years behind, you could also use discount cash flow. When it's a startup, it will be more difficult. Asset base, we have covered it on this. Selection criteria for investors, we went through it. At the end, it is going to be the alignment with your values. It is going to be the value that they could add to your business. This is quite important. It's going to be the alignment in terms of what you want to do over this period of 5 to 7 years. And it's so this is quite important. And rank it, discuss it, and then go and meet as many people as you can. Profile of investor based on maturity of company. Okay, typically what it does is you go through different phases. So if you ask when you start, take the example of Ali. Ali has started, he has put money from his own pocket. So him and his wife they've put money in their own pocket. Next step, this is what we call the 3 Fs, the friends, family, and the fools. So this is money that it could be 10K, it could be 20K, it could be 30K. This is the money that you get up front. Then what he did is he went to an accelerator. He went to Speed. We have different accelerators in Lebanon. We have UK Tech Hub, you have Speed, you have Agritech, you have others. What they do is they give you 30K, they give you 50K, and then they take equity behind it. So this is a second phase. So what they do, but by doing this, what they are doing is they're validating their company. So they tell you, we're going to take 10% of your company, but we're going to give you $60,000 worth of money and worth of services. So automatically his company is worth now $660,000, not 600, because it's 60 that they have put in on the basis of 600. So by doing this, what he has done, he has moved his valuations for probably 0 or very little to 660. Now he is now in the phase, say, Constantin, okay, I'm graduating from it. I need to have my second round of funding. So what he typically does is that you have a number of others. This could be business angels. It could be venture capital that do on this between 100 to 200K. So this is, first phase is the family, friends, and fools. Second phase is you go through an accelerator. Third phase is the post-accelerator, 100K, 200K, 300K that you have. And this is the most difficult one because you have it's easy to get the accelerator funding and it's easy to get venture capital. But in between, so you need to look at creative ways to be able to get this money. So this is the third phase is when you get to venture capital. So IM Capital, you have a number of companies in Lebanon, Berry Tech, when we started, Sami presented what they have. It was Fund 1. We have Fund 2. MEVP is another one. You have BNY. You have Phoenician Funds. You have, who else do you have, Yaraja? Cedar Mundi is another one. So you have what? Leap, you have about 7 or 8 of these funds available. Some of those belong to 331, i.e. central banks. Others are independent of 331. So what I'm saying is that you are going through, as an entrepreneur, you're going through different phases. I start by taking money from my own pockets, from my friends. Then I move to an accelerator. After the accelerator, I move to a post-acceleration. Then I move to venture capital. And this venture capital could be 1 round or could be 2 rounds. And then I could move to private equity, which is in the range of $5 to $10 million. So I started with 5K, 10K, moved to 50K. From 50K, moved to 200K. 200K moved to 500K, and I could move up to 5 million. In Lebanon, you have players across this. When you reach to the $5 million level, there is very little in Lebanon. So this is when you have to reach globally and what you have to reach regionally. So now we are setting a program to look at ways to get not 5 million, but to get to Series A. Who mentioned Series A? So you have Series A. So this could be $10 million. It could be more. And we're trying to get, so we're breaking the boundaries in Lebanon to help companies get more than their 5 million. The maximum that we have funded as Beritech Fund 2 was $5 million that we have done. So now we're going to a higher level. So these are all phases. The more you go through these phases, the more mature is your business. Because investors have checked, investors have put in the money. So what happens is that your discount rate was probably, like René mentioned, 50% or 70%. Over that you go through these phases, your discount rates become lower and lower. Your ability to manage risk is higher and higher. Your maturity in terms of a business is better. Your team is getting stronger and more complete. So these are ways for you to be able to go through this. So these are the different phases that you go through. And you typically would have 4 or 5 different phases. And you have in Lebanon all the support structure that you go through. So what is the investors? The more, when you start, these are investors with very high risk appetite. I'm willing to take the risk of you going bankrupt. The more you go up, the level of risk of the investors become lower. But then they will pay a much higher valuation. So what happened is that the profile of your investors are going to change as you go from seed, i.e. from an idea stage, to when you have a prototype. This prototype has been demonstrated. You have clients coming to you. These clients are actually generating revenue that is allowing you to be profitable. All these phases the profile of the investors will become very different from a risk perspective and from an expectation or return perspective. If I'm funding Rula when Rula started, I'm expecting a return which is probably in the area of 25, 30, 50%. When I'm funding Rula when she has already 5 years or 10 years behind her and she's her business, then my return expectation will be much lower. So the risk profile will be different. The return expectation will be different. Do you get me? Do you understand? So different phases of in this cycle. These different phases will require different investors. These investors have different risk profile, and these investors have also different valuation expectation. Okay? So this, I'm trying to answer your question here. So here, the number of board seats versus the growth phase. When you start, limited number. You might not even have a board. It's more of an advisory. As you grow and as you get more investors, these investors would want to have, if I'm putting $500,000 or $1 million, I want to have a board seat. So you have to manage in a way, if you have too many investors, بتصير عملية فوضى. If you have like 10 and each one would have a board seat, too many cooks, you spoil the food in this. So what you need is you need to always have a balance. Ideally, I would say 5 to 7. It could be 7 to 9. But we want to manage within these. So as you move to other investors, you need to make sure that maybe some of the investors initially that are diluted, maybe they need to move out of the board so that you keep the board to a number that is manageable. If it's too large a number, it's not going to be manageable, and you have a lot of discussions, and it's become difficult. So always keep this, I'm answering the question here, the number of board seats will increase, but make it sure that it doesn't increase beyond a certain number. In most cases, I would say 5 to 7. In some cases, when we have larger groups, 7 to 9. But these will be the typical type of numbers. Okay, term sheets. I will show you the term sheet, and I will show you what a bad term sheet is, and this will open your eyes in terms of what you could sign up. I will have a separate discussion. The valuation milestone, this is what Raja has mentioned. I'm not going to argue with Marie-Michel. If Marie-Michel wants to set up her business with her daughter, so she's decided, so Marie-Michel said, I'm going to do $1 million here, I'm going to do $2 million, I'm going to do $3 million. I said, no problem. If you're going to make these numbers, I'm willing to give you a valuation which is high. But in case you do better than these numbers, I will actually give you a higher valuation, and I'm willing to dilute my share and give it back to you because you have over-delivered. In case you do lower than your valuation, then the reverse will take place, i.e. my share becomes higher because you have not delivered. So this avoids the emotional discussion up front because everybody thinks that I said, no problem. If these are the numbers, we'll do the valuation based on these numbers using the figures that I have discussed. If you are making it and over-making it, I reduce my share. If you're not delivering, I will increase my share. So this avoids a lot of emotional discussion up front, and we do it based on the actual result that you have delivered. So this is quite important in terms of the negotiation. And these are, if you want, the valuation milestone are typically either revenue, or these valuation milestones may mean number of customers. These valuation milestones might be different elements, could be profit in case you're in profit. So you agree on what are these milestones that you will hold the company owner accountable for. Okay? Is this clear? Okay, I'm going through your dynamics between investor and founder. This is very... Now, here you had discussions. You had Sami and you had Ziad. Now, the reality is that there is a lot of emotional discussion that takes place. And typically what you do as an investor is that you want to get out at a certain point in time. So what is the best way? The best way that you do to minimize it is you agree on what can an investor, what is the CEO or major shareholder accountable for, and what he needs to go up to. This delegation of authorities needs to be clear so as to avoid misunderstanding. Now, this is one area of, because in the case of Ziad, he's very polite, he didn't say, but he will tell Constantin, I'm trapped. Everything investment that I need to do above a certain level, I have to go back to the board, and for the board to meet and to come back to me, this could take 2 weeks, could take 3 weeks. I would have lost the order in this case. So how much do we delegate to the CEO versus how much the board is one subject of important direction. So these delegation of authorities, the clearer there are, and the better it is for the organization. The other thing is that this delegation of authority will increase. If Lina and I are in business and Lina wants me, I will probably tighten I will not give her a lot of autonomy to decide because I don't know how well she does. The more she delivers, the more I'm willing to give her as authorities. So instead of her coming back to me for $10,000 and above, I would say it could be $20,000 or it could be $50,000. So she earns my ability as an investor to give her more autonomy to take decisions. But this is earned depending on her ability to deliver. This is quite important. Trust needs to be earned. You say what you're going to do, you deliver on what you do, the trust level high. If the trust level is high, you get more autonomy to be able to do the things that you want without having to come back. So this equation, this balancing act is an important balancing act. Is this clear in this part? So this is the dynamics, and this could be another type of discussion. Again, it's not here, but with Sami, but the CEO wants to have high compensation. A number of the cases where I have CEOs, but at the same time, he's a majority shareholder. So he says, Constantin, I don't want to be paid $4,000. I want to be paid $10,000. This is the data. This is what the things. And you do. So you get into discussions on how much you want to compensate and how do you think you find the best answer to this. So you have an owner who is at the same time a majority shareholder, and this person wants to have a compensation package which is higher than what you think is affordable. How do you go about dealing? Because these are real topics that cause emotional friction and tension. How would you handle it?
It's about balance. Because when you want to cash out, he's a majority holder, and this big salary will affect the costs of the...
Okay, so this is a very, very good answer. And actually, it's an answer that is used in a lot of cases. I forgot your first name? Amir? Abed. So in the case of Abed, so let's use Roger. So Roger has today a salary of $5,000 a month. And he said, Constantin, I'm $10,000 worse. He's at the same time, he owns 60% of the company. We have valued the company, let's say, at $5 million. So I say, Constantin, I'm making 60,000, I should be making 120,000. This is my real value, this is what I'm valuing. So what Abed says is, look, why is this? You are today 60% share owner. The company, let's say, is worth $5 million. By my increasing your salary from 60,000 to about 120,000, I'm actually increasing the expenses by $60,000, i.e. I'm reducing the profitability of your company by $60,000. These $60,000, if I use the multiple, means that because the value of your company is, I'm sorry. Okay. Yes, okay, sorry. So what you do in this case, what you are doing is that you are reducing the value of the company not by 60, but by 10 times 60, because typically it's 10 times. So although you are making 60,000 more, the reality is that the value of the company is going down by 600,000. You are 60% owner, so on one side you're earning 60,000 more in your cash, but the reality is that you are reducing your value by 360. So the net effect of the salary increase is that you are losing in your pocket 300,000. So this is an important discussion, and a number of majority shareholders go through, and then we have to explain. So this is one way of doing it. What is the other way to avoid this problem? Markets. So what you do in the market is you say, look, I'm going to have a benchmark, and I see we have about 30 companies. We know what is the salaries. This is the salaries that we're making. We believe the range is so much. You should be in the range. $10,000 on the high side, we don't. So benchmarking with data, and the more companies that we have funded, the more data we have, and the more knowledgeable we are, and the person. And what we do in these cases is we do look at the market, look at these benchmark in terms of salaries, in terms of compensation, and we come back. And if the person feels that he is not earning what he deserves, there's going to be an impact on the business. So what you tend to do is link it to performance. Always link it to performance. The person delivers, the person has all the rights. So it's a win-win situation. If the person does not deliver, then we have an issue. Not only we have an issue of compensation, he might not be the right person. Although he's a majority shareholder, he might not be the right CEO for the organization, and this will be another subject of discussion. Okay? So this is one on term sheet. We'll go valuation milestone, dynamics between investors. It's important. It's important because you have a number of situations. We face a situation, I won't name the companies, where the investors decided, I'm quitting. I'm not interested. I'm going to find investors. We don't get along. The value alignment is not there. And I had cases where investors decide, I'm calling the shot, I'm throwing the towels. Even if I'm exiting at a value which is lower than the value that I entered, I'm not interested anymore in dealing it, because the dynamics between the CEO and between the investors became fairly problematic. So very important that you do with these situations, because it might interrupt and it might affect the business. Now, exits.
Okay.
Yes.
I have a question regarding this.
Yes.
So if the dynamics between the CEO and the VC or the investor are not working well,
Yes.
cannot he wait until they reach another round? Because then he can exit with the round.
Yes.
Yeah,
No,
if
you.
هو عنده preferential shares,
Yes.
he can exit with the next round.
Yes. No, he
Why
can.
would you exit with a lower
Okay.
valuation?
It's a good question. Why would you exit with a lower valuation?
To punish the entrepreneur.
I know in some ways you are, because if you're exiting with low valuation, it means that the new valuation is going to be the valuation at which you exited. But there won't. I mean, it's. What do you think? I mean, I could give you a couple of answers. Yes.
There's the time value of money. Maybe there's an opportunity once to get.
Exactly. So this is an important one. So maybe this investor has another opportunity which has a much higher value creation potential than the existing one. So I prefer to exit, take a cut, invest my money in another one which I know has a much better valuation. So this could be one way you do it. Yes. There is. I mean, if you have a lower, if you exit at a lower valuation, you have penalty, because you are basically losing money. You've invested at a valuation, let's say, of 10 million. You're exiting at 8 million, and if it was 10% share, you lost the 10% of the 2 million, i.e., you lost $200,000. So this is. So there is, in some ways, penalty will be there. Yes, Eliane.
Actually, legally, isn't there a law binding the investor with the company where it specifies at what time they can exit? They're
Okay.
allowed to exit. If they exit, they pay a penalty.
Yeah.
Or something?
Samer is going to cover at 5 o'clock. He will cover shareholding agreement. In the shareholding agreement, one of the clauses in there are clauses saying when can you exit. Can you exit maybe before the 5 years or the 7 years? So all this is in the contract. So and there will be several reasons where I would have the right as an investor to exit, or vice versa. The shareholder, major shareholder would like. So all these will be done not by it will be by the shareholding agreement that both parties have signed. So yes, this will be specified. This will be negotiated and documented and applied. So it is in the shareholder agreements.
Another question: if the person who is a shareholder, investor, someone has put his hand on his money legally for a certain reason, does it attain his shares also in the company, and would it affect
Okay.
the company or not?
All right, this is different. So if a shareholder, for instance, is a shareholder in a company, and let's say he has signed a personal guarantee on a different to a bank on this, and then this venture went down, then as the bank has the right to come back and to claim or to take. So this will be this is part of the assets, the same way that you have. I'm sorry. It depends. So if he is the shareholder and this is part of his assets and he has been exposed, he signed a guarantee that he's not in a position to, then the bank has the right to come and to follow and to take positions on these, or at least to take.
They will take his share.
They will.
They will not affect the company.
No, it will not. It will not. No.
You change owners.
You change owners. So the owners, he would have to sell, and then to the company is being the same. Okay, the exit opportunities that you have is normally when you get in your shareholding agreement or in your term sheet, you will specify the terms of the exit. This actually is probably one of the most contentious area in a term sheet, because a number of cases, the one I will show you here, is that the investors is asking, we will exit at a certain valuation, but he is asking a minimum value that he wants to get back. So this is because he wants to protect. So he's putting a floor. He's saying, so this is in the. So this is why you need to be very careful about what you're signing on your exit, because they will say on the exit one what time they want to exit and at which condition would they exit. And sometimes the condition is the value of the company today, if there is, or it will be a minimum value which will be, I don't know, 6 times the operating profit or 8 times the operating profit, or a minimum value of so much. So this is, and I'll show you the examples. So it's important that whatever you're signing in terms of exit is not compromising, because if you are guaranteeing a certain return, it means that the investor is not sharing the risk. It means that the investor is still having the risk on your shoulders, and I want to get the return independent whether the company is doing well or whether the company is going down. And this happens in a number of cases, and we as advisors to these stopped these. And we had cases where we were very close, and then we decided not to, and I'll show you some example of it. So this is quite important, and I'll show you what not to go for. Okay, I'm going to cover, we have now received the money. We have done the valuation of the company. We have decided what are the screening criteria that we want to have for the investors. We courted several of them. We decided to work with this one. We have agreed on a term sheet, and I'll show you an example of not to do in terms of term sheet. Now we have received the money. What I want to focus over the next 10 minutes is what do we do with this money? So this money, you will have 3 or 4 initiatives. I'm showing with you the simplest way to be able to measure what are the returns on these investments, because you will always have initiatives. Give me examples of what should be initiatives. We receive, if Ali is asking for, how much are you asking, $500,000? $500,000. What do you think would be with $500,000? Typically, what will companies invest in when they get the money? What are the type of investments they make? Staff is one. What else? They could have machinery. So I have machinery. They could have marketing. So marketing is customer. What else? Research. They could do some product development. What else in terms of? It would be? Expansion. It could be expansion. So I want to open up new. So you have different ways. Now you as the founder or you as a board will have to assess where do I get the best return? Where do I want to put my money to get the best return? The investments could be in new products. It could be in new markets. The investment, and we'll get copies of all these slides. It could be replacement if you have some assets. It could be research and development. It could be that you want to buy another company. So Ali might be interested to buy another company to get their customer base, or it could be others. So you have this. Now, what is interesting is that, I'm sorry, go ahead. Or you could repay debts. You have borrowed money and you want to repay debts on it. So we have. I'm sorry, why is it's not what I was looking for. Oh, here it is. Okay. So what we do is, these are the 3 ways. So what you do is you have 3 ways to measure what is the return on your investments. So the first one is the payback period, i.e., he is investing in, forgot the name of the company. Okay, so he produces cider, or let's say he produces cider, he takes the apple, produces, he needs a piece of equipment to be able to do it. So let's say the piece of equipment is worth $50,000. So he takes all these apples, puts them, and then provides ciders behind it. With $50,000, I want to know how much incremental profit he's going to generate. So if he tells me, Constantin, it's going to take $20,000 every year in terms of incremental profit, so what does the payback period do? $50,000 in upfront investments. If I make 2.5, who said 2.5? So basically 2.5. So Zacchaeus said, so it takes me 2.5 years to recover my investment. I'm putting 50,000. Every year I'm recovering 20,000. So what is my payback period? I.e., how long does it take for me to recover my 50,000? It's the easiest way. It's the easiest way in everybody's mind. They look at the investment and they look at how many years. Typically, the shorter the number of years, the better is the investment. But if you're in real estate, it could be 7 years. It could be 10 years. If you are in trading, it could be shorter. So depending where you are. So this is one simple way to measure the return. And when you deal, so in their mind, whatever is 1 to 2 years is excellent. What is 2 to 4 years could be average. What is 5 or 7 years in the future could be more problematic. So this depends on the shorter, the better. So the payback period is the amount of times it takes you to recover your initial investments. Now, what does the payback period does not cover? Okay, inflation. So inflation could be one. What does it not cover?
Present value.
Is you don't know how much value. You know how long it took you to recover your investment, but you don't know at the end of the day how much value is he creating for his company. Is he creating 0? He might recover in 2.5, but after 2.5 years, nothing happens. So I want to know what happens after the period that you recover. So I want to know how much money is being created by this, and this is what the net present value does. The net present value say, okay, it's $50,000. These $50,000 every year is covering about $20,000, and it's over 5 years. So I know that total, if I bring it back, it's 5 times, so it's 100,000 minus the 50. I'm creating 50K if there was no depreciation of value. So this net present value gives you an indication of how much value has been created. So think of the payback period, but also think of the net present value. Now, this is exactly the same, the internal rate of return, as the net present value. What it does is if, for instance, we have created 100,000 from your 50K, means that you have doubled your investments. So you've invested 50K, but you got 100K. So when you double it, it will give you a percentage, i.e., how much in interest would you gain. So for instance, if I want to compare it, if I took these 50K and put it in a bank account, and I got 100K after 5 years, what has been my interest? On average, the interest will be about 18 to 20%. So this means that you have another way of finding it. Either I found how much value I created, or I find what is the equivalent interest rate if I have put it in deposit. So these are the 3. This one is very simple, limited in terms of payback. The net present value gives me a certain valuation, and the internal rate of return gives me how much is the annual return that I have done. So I take the example. If I do this, and I realize that my net present value is negative, i.e. I've put 50K, but I'm only getting 10K, 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 then 5K and 5K, I'm actually negative by 10K. So it shows me that I have destroyed value. So this investment has not been a very good investment in this case. So this gives you measures of these. So if it's negative, we won't go. In the case of internal rate of return, if the internal rate of return is below a certain value, i.e. if it's below the interest rate that you get if you have put it in a deposit account, it's not worth it. I would have put my money in a bank, got 10%. With you, I'm getting 6%. I'm losing. So this will be the ways you look. So you normally want to have an internal rate of return which is higher than the benchmark. And the benchmark is typically either the bank deposit that you get or what you expect in terms of an equity shareholder. Net present value needs to be positive, then you're creating value. If it's not, you're destroying value. And the payback period is how long does it take, the shorter the better. So these are 3 ways. I don't want to go through in this. You have calculation, you have examples of how we do this. Now, in your life, every single day, you're making these, but you don't consciously understand it. When you decide to buy a car versus leasing a car, you're making this. If you decide to rent an apartment versus buying an apartment, you're making this. Because when you buy an apartment, what you do is you look at, I'm paying $1 million for this apartment. For this $1 million, if the value of the apartment increases, and how much rent I'm not paying, so you make indirectly what is going to be the value that you have created on this $1 million investment. If on the opposite you have rented the apartment, you do, and then you could compare the two. And you will see that in most cases, actually renting an apartment is money out of the window because you have no, and buying the apartment might be much, unless the value of the apartment goes well down, or unless what happens is that you want to have the flexibility after a year or two to shift because you are moving somewhere else. So these, you do it unconsciously, buying cars, buying apartments, even on the education of your children, or when you decide to buy a land versus starting a new business. All these decisions are decisions that you do on a daily basis without even realizing it, and these are ways to help you monitor. So from time to time, I have friends to me that come, say, Constantin, I'm faced with this situation. How do I handle it? We go through this process. Now, financial returns is one element. One element. What to measure if I decide to go or not to go. What is the other elements? So financial returns will tell me where am I making the more money. If I have $50,000, should I invest it in this company? Should I invest it in another company? Or should I invest it in third? So this is one. What are the other criteria that would allow me to decide how I want to allocate my funds?
Future value.
It's what? What is...
Social
Okay, what you do, one could be social impact. So not only the financial impact, what is the social impact? Social impact more and more for investors. I use the example of my elder son. He didn't go for the offer that was the most interesting. He went for the company that has the highest social impact. So he's in the biomedical field. He knew he was saving lives. For him, it was much more important on this case. So these will be examples. So social impact would be one. Financial return is another one. What is the other way to decide whether you... What?
Interest. I have interest in something.
Okay, you have so alignment in the values. You have a third. To keep it simple, we typically look at, and I used this before, in any investments, what we do, one is you look financially. Is this financially viable? Yes or no? It is, which is in the financial return. So the future value, so this is one. The second one that I look at is how aligned is it with what I want to do in the company. So the strategic alignment is quite important. If, for instance, Rula is in the dental business and then suddenly she has this investment which is in ice cream making, it's not necessarily highly synergetic. If it was, for instance, moving from medical for children to moving medical to adults, this is an expansion where she's building and there is synergies behind it. So strategic alignment is the second dimension. The third dimension before deciding is she capable of implementing it? Because if this is stretching her, does she have the resources to have another dental factory, or not the factory, a dental office in it? So financial returns, the strategic alignment, and the ability to execute are typically the screeners that you decide whether you go for one investment versus you go for another investment. Disruptive would be ways also to decide one company versus the other. We mentioned others, the leader, how open the leader is, how much of a visionary. So these will be criteria that we have. I'm not going to cover more in terms of investment management. So but it's a foundation. In the slides, you're going to have it. Most of you all of you, if you're on the distribution list, will receive the slides behind. Okay, so these are it's very important that you look at investments, look at the return that you get, and then decide where do I put my eggs. If these are poor decisions, when I first started, as I mentioned before, with the company that I was, the first thing that I have done, and I've looked back, and I look back at all the investment that the company has done over the past 5 years. I look back at the return of these investments versus what they budgeted for. And this was an eye-opener because we realized that out of the 10 largest investments, none of those investments delivered on what they're supposed to deliver. And actually, most of these investments have destroyed value in the company. By looking back, what you're doing is sending a signal to the board, you have not done your job. these are the investments, this is the return that you have on these investments. So there is, you raise the flag that this is not working the way. What you do is you also take the learning. Why did these investments fail? And you take the learning and try to apply the learning in new investments. So this is very important. The quality of your investment as a leader will make or will break your company that you do. So this is, and these are ways to be able to measure it. Okay? Now I'm going to break at this point. Samer, I know we don't have a lot of time. The topic here is a topic of shareholder agreement and term sheet. So you will see examples of how this shareholder agreement, what are the different components of it.